Um, Friday, August 07, 2026. The opening bell rang on the U.S. stock market today, and, well, if you were only watching the indices, you'd probably assume the economy was running perfectly.
Trading floors seemed genuinely buoyant, equities ticked higher across the board, and the mood felt decidedly optimistic. But the catalyst for all this cheering on Wall Street was an official jobs report that, on the surface at least, looks surprisingly bleak.
The paradox we're seeing play out on the trading floor today is that bad news for Main Street often translates into a bullish signal for investors. So today, we are unpacking the economic mechanisms creating these bizarre distortions.
We are pulling from a really fascinating stack of sources for this analysis. We've got official Bureau of Labor Statistics data, aviation analyst notes, earnings reports from major tech and restaurant chains, and agricultural dispatches from the United Kingdom.
Our mission here is to help you spot the hidden incentives behind those headlines. We are cutting through the dry analyst jargon to understand how these market mechanisms actually impact your wallet, your work, and, the products you buy.
Before we get into the July 2026 U.S. jobs report, we should note that employment data, inflation metrics, and Federal Reserve policies frequently intersect with politically charged debates.
And we are impartially reporting the data provided in our sources. We are not endorsing any political viewpoints, but simply conveying the economic ideas and metrics contained within this material. So, looking at the numbers released on Friday, analysts had projected a modest but healthy addition of 80,000 jobs.
Instead, the economy shed 23,000 jobs. Local government, education, retail, they all saw notable cuts. And the previous 2 months were also revised downward by over 100,000 jobs.
Yet in the middle of this contraction, the official unemployment rate actually dipped from 4.2% to 4.1%. How does the rate drop when the economy is actively losing jobs?
The math behind that drop reveals a highly concerning mechanism within the labor market. The official unemployment rate is not a simple count of everyone without a job. It specifically measures individuals who are jobless and, crucially, actively looking for work.
Meaning, if you become discouraged and stop submitting applications, you are no longer considered unemployed by the official metric.
That statistical quirk explains why long-term unemployment fell by 64,000 people from June to July. It declined for the wrong reasons. We are seeing a significant exodus of workers from the labor force entirely, with participation currently sitting at its lowest level since February 2021.
People are experiencing what economists term a low-hire environment. They're sending out hundreds of resumes, facing months of silence, and simply giving up the search.
The perverse incentive here is how the financial markets digested this data. Wall Street cheered the drop in active job seekers, pushing stocks higher because it gives Federal Reserve Chair Kevin Warsh a statistical excuse to scale back on interest rate hikes.
But out in the real economy, consumers are still battling elevated inflation. Average gasoline prices are pushing back over $4 a gallon, and diesel is nearing $5.40. Wall Street cheering a drop in unemployment driven by people giving up is, well, it's like cheering that your car stopped making a weird noise, only to realize the engine just fell out on the highway.
That mechanical failure extends directly to household balance sheets. For the individuals dropping out of the labor force, the financial risks compound rapidly. Once you pass the 6-month mark of unemployment, state benefits generally expire.
And the longer the absence from the workforce, the harder it becomes to re-enter, which tends to drag down the eventual starting salary.
The market is celebrating the prospect of cheaper borrowing costs for corporations, while completely ignoring the structural damage being done to everyday consumer spending power.
Wall Street is essentially rewarding companies for shedding risk, and we see that in the hiring freezes. But companies are now taking that exact same risk-shedding playbook and applying it to their own executives, which brings us to the front of the airplane.
Delta and United have recently introduced basic business class tickets. This is the unbundling strategy that previously carved up the coach cabin, now creeping into the C-suite.
A basic business class ticket strips away lounge access, removes the ability to select a seat in advance, and most importantly, introduces brutal cancellation and change fees that can run up to $500.
The corporate travel manager is suddenly facing a complex mathematical dilemma. Consider a United Polaris ticket from Newark to London for early October. The base fare is priced at $4,490, while the standard, fully flexible fare is $4,890.
On paper, the travel manager sees a $400 saving by choosing the basic option. However, corporate travel is inherently volatile. Client meetings get moved, mergers get delayed, schedules just change on a dime.
That initial $400 saving can instantly evaporate, transforming into a massive change fee or the total loss of the nearly $5,000 ticket value.
When you break down the actual product being sold here, airlines are no longer just selling a lie flat bed or a premium meal, they are selling flexibility.
By removing that flexibility from the base fare, the airlines are forcing corporate travel managers to buy expensive insurance against schedule changes, cleverly disguised as a premium ticket tier.
If your company tries to enforce a strict policy of only buying the cheapest available business class seat, they are taking on a massive financial risk every time your calendar shifts. And if you enjoy untangling these kinds of weird market incentives, you can find financial candy, brain candy, and classic audiobooks at clarineratio.com.
Airlines have successfully isolated the single most valuable component to a business traveler, the ability to change plans without penalty, and put a distinct, steep price tag on it. It is a brilliant strategy for driving up total revenue while appearing to offer a lower entry price point.
The burden of risk is moved entirely off the airline's ledger and onto the corporation's travel budget. The airlines secure their revenue whether the executive actually boards the plane or not.
This corporate drive to isolate costs and maximize radical efficiency is doing more than just downgrading business class tickets. It is fundamentally rewiring how companies build and buy their technology.
We are currently witnessing two massive contrasting shifts in the software industry. First, we have what analysts are calling the syspocalypse investors dumping traditional software as a service stocks.
Airtable, a prominent workflow management startup, just sold for $1.3 billion. That is a staggering drop from its 2021 peak valuation of $12 billion.
The counter-narrative to that collapse is the massive productivity boom driven by artificial intelligence. Grindr provides a perfect case study of this second shift.
The company spent $6 million on AI coding tokens, utilizing tools like Anthropic's Claude and the AI-assisted code editor Cursor. By deploying these tools, they increased their engineering output by 2.5 times without adding a single new developer to their headcount.
To achieve that same technical output prior to generative AI, Grindr estimates they would have needed 200 additional engineers, carrying an annual cost of roughly $60 million.
Spending $6 million to save $60 million allowed Grindr to comfortably raise their 2026 revenue guidance to $540 million.
But this presents a massive contradiction in the market. If every company can suddenly build their own internal tools 10 times cheaper using AI, doesn't that inherently destroy the pricing power of traditional software as a service vendors?
Why would your company pay a massive monthly subscription for a workflow tool when your own internal engineers, supercharged by AI, can just build a bespoke version in-house over a few weeks for a fraction of the cost?
The immediate reaction from the market was driven by that exact fear, prompting the massive tech sell-offs we saw earlier in the year. Investors assumed all subscription software was suddenly obsolete.
The nuance emerged on Friday. Stocks like Atlassian, which provides enterprise collaboration and workflow software, suddenly surged 35%, posting their most profitable quarter since 2021.
The lesson here is that while writing basic code is undeniably getting cheaper and faster, deeply entrenched corporate workflows possess a massive protective moat.
Ripping out a system that an entire enterprise uses daily, simply because you can build a cheaper clone, disrupts operations on a scale most executives are unwilling to tolerate.
It is the difference between building a standalone tool and operating a vital nervous system. AI can absolutely write the code to build a new collaboration app over the weekend, sure.
But AI cannot force 10,000 employees to abandon their established daily habits, migrate years of historical project data, and retrain their entire departments by Monday morning.
The software companies getting crushed in the SaaSpocalypse are the ones offering easily replicable utilities. The ones surviving and popping 35% on a Friday are the ones that have woven themselves into the behavioral fabric of a corporation.
Tech sentiment can swing wildly based on AI capabilities and workflow modes, but consumer sentiment is proving to be even more fragile, especially when supply chains and the physical world are disrupted.
The ultimate uncontrollable risk is human psychology combined with physical agriculture. Sweetgreen, the fast casual salad chain, watched its stock tank 15% after cutting its full-year 2026 outlook.
They are projecting a 7% to 8% shrink in same-store sales, specifically citing reduced consumer demand due to a massive Cyclospora outbreak in Mexican iceberg lettuce.
The truly crazy part of that data point is that Sweetgreen was never implicated in the outbreak. The FDA explicitly linked the contaminated lettuce to a Taylor Farms facility supplying Taco Bell.
Yet, Taco Bell sales are already bouncing back, while Sweetgreen is absorbing a massive financial blow. Consumers developed a halo of fear around the entire category of fresh produce.
A customer sees a headline about a waterborne parasite in lettuce, and they suddenly decide to skip the salad bar entirely. They end up punishing an innocent company that had absolutely nothing to do with the tainted supply chain.
The market mechanism operating here is a classic reputational tax. The reaction is blunt and indiscriminate. When trust in a physical supply chain is compromised, the consumer does not parse the logistical details or check the FDA's specific vendor list.
They abandon the category entirely to protect their own health. And this vulnerability of physical disruption extends beyond contamination and into the weather itself.
In the UK, a severe drought, the driest July in 190 years, is completely redrawing the agricultural economy. Wiltshire farmers are getting hammered.
Phil Collins, a vegetable farmer, lost 6,500 cauliflowers to the heat. At roughly $1.65 matori apiece, a single field represents a significant financial loss, forcing him into his first bank overdraft in 30 years.
Just 50 miles away from those dying cauliflowers, Somerset winemakers are experiencing an unprecedented boom. The same scorching heat that destroyed the vegetable crops caused English wine production to jump 55% from the prior year.
The vineyards are sinking deeper roots, the grapes are producing higher sugar content, and winemakers who are traditionally limited to sparkling varieties are now successfully pivoting to premium still red wines, commanding much higher margins.
Markets blindly reallocate wealth based on these physical disruptions, regardless of fairness. Sweetgreen is forced to pay a reputational tax for the fast food industry's supply chain mistakes.
UK vegetable farmers are paying a severe climate tax, unable to afford the irrigation required to compete with supermarket pricing structures.
Simultaneously, those Somerset winemakers are collecting a massive climate dividend. They are inheriting the exact growing conditions that central France enjoyed 20 years ago, entirely by geographic luck.
Synthesizing the distinct pressures moving through the economy as of August 2026 reveals a clear pattern of risk reallocation. From the illusion of the labor market data, to airlines unbundling business class, to software coding and agricultural supply chains, the surface-level numbers rarely tell the whole story.
The market is rewarding radical cost-cutting, prioritizing ruthless efficiency, and severely penalizing any entity caught holding inflexible or uninsurable risk.
Airlines shift the financial risk of schedule changes onto the corporate travel manager. Discouraged workers absorb the economic risk of a frozen labor market.
Innocent restaurant chains bear the reputational risk of a fragmented food supply, and farmers carry the uninsurable risk of a changing climate.
The entities thriving are those that can adapt instantly to shed that risk, like Grindr deploying AI to bypass the need for a massive engineering team, or winemakers pivoting their entire product line to match the new weather patterns.
It leaves a lingering question regarding the future of corporate structure. If AI coding agents continue to make software incredibly cheap and fast to build, what happens when Fortune 500 companies realize they do not need to outsource anything anymore?
Will we see a complete reversal of the last 20 years of cloud computing, moving away from external subscription models and back to a 1990s paradigm where every major corporation simply builds and maintains its own bespoke software entirely in-house? That's Financial Candy for Friday. We'll be back on Monday. If you need some weekend listening in the meantime, be sure to check out Brain Candy or Sunday Candy. Take care.